2019 Financial Results Conference Call. I now hand over to your host, Melikşah Otku, CEO. Sir, please go ahead.
Thank you very much. Welcome again to another investor conference, teleconference, which is done simultaneously on YouTube as a live cast. It has been a tough quarter in Turkey for especially the banks. As you all know, the fluctuation that started in mid-August continued into mid-September. Within that one month period, as you know, there were a lot of jitters in the market, both from domestic participants and international investors, especially because this was a time when banks had their syndications, roadshows, and preparations. Some had it towards the end of September, October, going well into November. The government, as you can remember, took several actions, most of which were done in line with the recommendations and deliberations with the sector participants. We had many different meetings at different levels, both at the very top level, then also on the technical level, with regards to what were the problems, what kind of policy actions should be taken, and the details of those policy actions. Obviously, there were a lot of concerns concerning the new government system, the independence of the economic authorities, economic policy authorities, and certain concerns about the deterioration of the budget. These were all addressed within that 1.5 month period. As you remember, in line with the recommendations coming from market participants and the sector, the central bank raised the interest rate by 6.5%, and which was much above what everyone expected, in order to prove the independence of the central bank. And a new economic program was announced afterwards, especially concerning the question marks about the budget deficit. The markets and the foreign investors took this in a more positive manner, and we can see now that the dollar exchange rate has come down back to 5.3%, 5.3 liras. It is reasonable level for the Turkish economy. We've seen the current account deficit diminish over the last couple of months. We expect that to continue. Obviously, the initial shock is now behind us. The banks were hoarding up liquidity. This will probably continue going into the first quarter of 2019, and they're pretty well in a much better position with regards to liquidity, in case the syndications and foreign liabilities do not roll over. But obviously, having the initial shock behind us doesn't mean that everything is now back to normal. Actually, we will be seeing a deterioration in the growth levels in Turkey. We're seeing that already over the last few weeks, especially on the real sector, in the construction sector, to a certain extent energy sector, but it's not necessarily concentrated in all sectors. Some, like the export sectors, are especially doing well, but there is also a widespread deterioration and slowdown in the economy. We are seeing NPL growth and new NPL inflows in the banking sector in general. With that, let me start the presentation. On page 3, we have a very summary of Albaraka's third quarter. As you can see, the asset growth has been at around 32%. Most of the growth figures are due to, as you know, exchange rate going up. More depending on the item, we have an FX position in those items. When exchange rate goes up, obviously that reflects as a Turkish lira growth in those items. You can see that in total assets, total funded credits, to a certain extent NPLs and deposits, and obviously also on the shareholders' equity due to the impact of the Tier 1 sukuk that we did in the beginning of the year. The same is not fully reflected on the income statement, obviously, with regards to these items in the income statement. The growth levels are more subdued. We have around 14% growth on the net profit share income. That is excluding the one-time joint venture Musharaka income that happened in 2017 and prior years. This year we did not have any income due to joint ventures. Around 17.5% in net fees and commission income due to banks and Albaraka Turk concentrating more on these side incomes because of the contracting margins on the credit side. Expenses also grow in a similar fashion, around 18%. But the largest growth, as you can see, is due to the provisions for loan losses. We will be talking about them in more details in the coming pages. And the net profit, there is a significant increase in that, again due to our position because of the Tier 1 sukuk. When you look at the key ratios, again, we are comfortable with regards to the capital adequacy ratio, although we have refunded and redeemed our Tier 2 sukuk within this year. Due to the impact of the Tier 1 sukuk, our capital adequacy ratio is 17.5%, which shows an increase on a yearly basis. Excluding the BRSA's additional steps taken during this fluctuation, if those steps were not taken, it would still be around 15.4%, even after the exchange rate growing our risk-weighted assets. And Tier 1 capital adequacy ratio stands at 12%. Again, if BRSA's actions were not taken, it would be 10.5%, still above last year's levels. NPL formation did continue within this quarter, so it's about 6% now. And provisioning, even during this time, was increased to 75.8% of the NPLs. Net profit share margins is essentially the same compared to last year, and return on assets is higher again due to the Tier 1 revaluation. Cost to income has come down to a certain extent because of the expense cost management, but also because of the enhanced income due to Tier 1. I did talk about the Turkish macroeconomic developments on page 4. We do expect growth to be subdued. We could see a contraction in the last quarter and the first quarter of 2019. If there will be a growth, it will probably come after the second quarter. We will see how the total year fares, but it will be a very low growth year, even if there is a positive growth. FX rate side, we are taking a conservative approach, assuming that the inflation will have some effect with regards to raising the FX rate. But this might not happen. We could see a more subdued FX hike in 2019 if the perception about the Turkish economy grows on the positive side. Currently, all Turkish assets are cheap in terms of the dollar, even with the dollar coming down over the last couple of weeks. So if there is a capital inflow, foreign capital inflow into Turkey in 2019, due to trying to take advantage of the high interest rates and the low asset prices, we could see a very flat or close to a very slow growth, devaluation on Turkish lira side. It is likely to stay below 6 by the end of 2019. But like I said, we took a conservative approach with regards to FX rate by the end of the year. Inflation, we do expect it to continue till there are going to be certain backlashes due to FX hikes that happened over the last couple of months. We are yet to see that coming into inflation rates. After that, it will probably, given the high level of the interest rates and the low demand, domestic demand, it is possible that it will come down to below 15%, and hopefully towards the end of the year back to single-digit figures, especially on the PPI side. Current account deficit, I already mentioned that there is a good performance there. The exports especially is helping. Tourism income is helping, and the imports, due to again domestic demand being subdued, is coming down. That is helping the foreign balance of trade balance, which will help with the current account deficit. On page 5, we have a summary of the macroeconomic outlook that we see going further. These are the expectations that we have taken into account about preparing the budget. The budget is currently in its formation phase. We started our budget process in July. Obviously, since that time, things have changed a lot. But it goes to our parent, Albaraka Banking Group in Bahrain, and we come to a common understanding towards the end of November and finalize it in our December board meeting. And in the next investor conference, I will be giving our budget figures as a guidance for 2019. But from a macroeconomic perspective, our outlook is that although the new economic program has put a curb on the public expenditures, especially the larger projects, and is expecting a better revenue collection, we believe that this is a little bit on the optimistic side. It is an election year in 2019, especially in the first few months. We will see a further deterioration in public expenditures, not fully being matched in the revenue collection side, to be compensated somewhat after the first quarter of 2019, not to the full extent that that is proposed in the new economic program. But I don't think that will be a major hindrance point in the Turkish macroeconomic picture, because, as you know, both the public financing side and the budget side, the Turkish economy is actually doing quite well compared to many of the emerging markets, especially compared to the European countries. Policy rates we expect to be continued at these levels until a significant lowering of the inflation is seen. It is not likely to be changed, especially to the lower side, probably until mid 2019, and probably even further than that. Domestic demand, we already mentioned that it is going to be low, and that is, I think, one of the major concerns that economic policy makers are thinking about. It is also hurting NPL asset quality of the financial sector. With regards to exports and imports, I already talked. There are huge record-breaking numbers coming in from the export side, and we are witnessing major drops in imports, especially after the FX rise, and also due to the domestic spending coming down. PPI and CPI inflation side, we talked about that. We are expecting that to build up up until the first quarter of 2019, somewhat stabilizing after that, and then going down if it does after that. The banking sector side on page 6 during this time has shown a significant growth with regards to total revenues. Again, most of the growth on the balance sheet, total assets, credits, and deposits has been due to FX hikes of the last episode. In real terms, especially in absolute terms also over the last couple of weeks, we are seeing credit growth in the negative territory. We will probably see that going further, especially as asset quality deteriorates. It has been easy for the Turkish banks to float their customers and the credits over the last couple of years. In 2009, the Turkish economy was hit at a as it was growing very fast. Many companies were caught to that crisis at the height of their investment cycle. So they had to both finance their deteriorating cash flows and also the recent investments that they had done. But over the last few years, the Turkish economic growth has not been too dependent on investments, but rather on spending. So many companies were only trying to restructure their financing based on the lower cash flows that they had. This did not change much in 2017 when we saw a major growth spurt due to Credit Guarantee Fund. Not many companies did investment. All the investment was done essentially to inventories. So it was easy for banks to restructure and float their customers, but that has come. There's a limit to that, and I think we are seeing that the limits now over the last few weeks as NPL formation has started increasing in the banking sector. Again, essentially due to CPI linkers and high yields, the revenue growth has been significant in the banking sector, not necessarily increasing the margins because the cost of funding has also gone up. The net profits, as you can see, has not seen such an increase in the banking sector, showing only 13.5% increase compared to the third quarter of last year. In the participation banking sector, we grew along a little bit faster than the rest of the banking sector, albeit are lower returns on deposits. We did introduce new products such as wakalas and sukuks to compensate the deposit return difference gap that we have with the banking sector. But when you look at the total weight and portion of those higher cost deposits or funding in the participation banking sector, it's still a minute portion. It is essentially to keep the commercial and larger deposit bases in the system, because there was a chance that those would go to the conventional banking sector. So we have been able to curb deposit outflow, as you can see from the table, in 2018, even with such a difference gap between the deposit rates in the conventional banking sector and the returns that we have on our profit and loss participation accounts. Because of the higher FX denomination of the balance sheet and the deposits, obviously the growth levels seem to be enhanced in the participation banking sector. But again, in real terms, the difference, the real growth is not that significant. From the net profits perspective, there is a significant increase in the participation banking sector, essentially due to side incomes like commission income and banking revenue income, and lower cost management, especially lower provisioning in other banks, in other participation banks. Now on page 8 we come to Albaraka's main highlights. The graphic on top left corner shows the three major balance sheet items: the assets, credits, and the collected funds. As you can see, the growth has not been very stable, especially in the first quarter. It was very subdued, and after the second quarter and the third quarter, essentially the growth has been due to on the total asset side due to FX rate hikes. But with regards to credit growth and deposit growth, although we do have FX denomination in both the credits and the deposits, those are coming lower. In our case, we are giving more attention to Turkish lira fund collection and Turkish lira credit, giving credits in Turkish lira. We are reducing our FX liabilities and FX credit allocation in line with the reduction in the FX liabilities. Net profit share income has seen a significant increase compared to the first couple of quarters in 2018. It is as much as the full year net profit share income in 2017. As you can see, we already reached that by the end of the third quarter. That is a significant rise, essentially due to yield rises, not because of growth in the credit portfolio. The net profit share margin did not change as much because of the cost rise in the cost of funding also. As you can see, net profit share margin did pick up somewhat in the third quarter, but the rise it might not be sustainable going further, because, like I said, a larger and a larger portion of our deposit base, our funding base, is being determined by these alternative products like sukuks and wakalas, which have higher returns, so they reflect as higher total cost of funding for us. And compared to, as you can see, the net profit growth has been essentially significant in the third quarter, again due to the tier 1 sukuk that we have. This will somewhat come down a little bit in the fourth quarter as FX rates relax to below 6 lira levels. On page 9, now we go into the asset composition. As you can see, the most significant highlight is the liquidity levels that we have. We now have around 28% of our assets in liquid assets, which are cash, financial assets, profit, and the money we keep with other banks and the central bank. The funded credits portion constitute around 67% of our assets, and we do have around 6.5% securities portfolio, which are government sukuks, and a large portion is also securitized real estate portfolios that we had as we exited our joint venture construction projects. These are listed on the stock exchange, and we were able to sell some portion of this to essentially to pension funds over the last few months. The value that you see around 930 million has come down from close to 1 billion because we sold around 70 million to these pension funds in the stock exchange. We believe that the figure will rise, especially after the new pension fund scheme comes in 2019, and as portfolios grow under pension funds. These have been very stable income generators for the funds that purchase them. The securities yields have also gone up in the third quarter, essentially due to the interest rate hikes that happened during this period. On page 10, we have the highlights of our operating performance. As you can see, the income has risen, both because of the profit share income rise, but also due to the revaluation of the tier 1 sukuk that we have. Trading income now constitutes around 17% of our total income, and profit share income constitutes around 76% of our income. When you look at the net profit share income, as you can see, there is also an increase in the net profit share expense, but it is compensated, like I said, essentially due to the high net profit share income, and the net profit share margin has increased reasonably in the third quarter because of that. But like I said, this might not be a continued trend. We could see a contraction somewhat in the fourth quarter and the first quarter of 2019 in the margin because of higher cost of funding, that is at least higher marginal cost of funding that we are now seeing on our base also. We do have a significant and reasonable growth on the net fees and commissions income. I think this is a healthy growth that we are seeing and will probably continue going into the future. One good thing that we have seen during this period when credit growth has been stagnant has been to give more focus on other banking income, and our branches has been increasing their cross-sales activities, and we have been pricing and generating income from other banking activities. The commission side especially grew reasonably on our letter of guarantee portfolio, because that grew, but also on the credit portfolio too, whereby we didn't see a significant growth, real growth on the credits. The commissions are still reasonably high because of the conditions that the Turkish economy and the market conditions that we are now seeing. On the cost and yield side, it is essentially, as I told you before, we do have higher yields, we do have higher cost of funding, but the net profit share margin has increased because of a better and conjunctural periodic rise in yields coming before the cost of before a rise in the cost of funding. On page 11, we have the funded details of the funded credit portfolio. As you can see, year-to-date growth on the Turkish lira side is negative. Year-on-year is still positive by 5%. On the foreign credit portfolio, which includes both the foreign currency credits and foreign currency index credits, as you can see, there is a significant decline in foreign currency index credits on a quarter-to-quarter basis, and which is reflected fully on year-to-date basis too, after the ban on foreign currency index loans in May by the central bank. We were expecting this, and as you can see, that some of that is reflected as a growth in foreign currency credits directly, but most of that reduction has been utilized as liquidity in our bank, especially during this period when we believe liquidity is more important for a bank than growth. Yield on performing credits has increased, as you can see, especially on Turkish lira side. We do see around 60-70 basis points increase on average. This is likely to increase somewhat in the fourth quarter, but it will probably be stabilized after that, as we are seeing a more stable rates both on the credit side and on the deposit side in the Turkish market. Yield on FX has also increased somewhat, and the blended as a whole has seen a significant increase of around 990 basis points since last year. The composition of our credit portfolio has not changed much. There has been obviously a lower retail credit growth, especially a contraction rather on the retail credit side, which has boosted the portion of the SME credits and the corporate credits in the bank. But as a whole, there hasn't been a significant growth in those segments also. The currency composition has not changed much because we did not switch much with regards to the credit portfolio. There has been a switch from foreign currency index to foreign currency credits. But in the long run, we believe that Turkish lira portion within the credit portfolio will increase. On 12, we go to the asset quality. And I think the most important aspect of our presentation, especially given the current environment. As you can see, NPL formation has continued in the third quarter. We now have around 6.2% NPLs. Obviously, the figure changes as FX changes. We have a lower FX portion in our NPLs than our credit portfolio. So as FX goes up, our NPL ratio does come down, and as FX goes down, our NPL ratio goes up just because of that revaluation of the credit portfolio and the NPL portfolio. But we do see new NPLs coming in, which will be shown in the next slide. And we will probably likely see this continue in the last quarter, and highly likely to continue in the first quarter of 2017 also. Stage 2 has also increased during this period. The first couple of quarters, essentially due to IFRS 9, the first quarter has a direct raise of around 700 basis points just because of IFRS 9. In the second quarter, we changed our criteria. We made them more conservative with regards to staging, especially in the second stage, for the second stage. And there another close to 3.5% rise has been due to that change in the conservative approach that we took, changing the criteria of staging in stage 2. But the third quarter has essentially seen new new staging inflows, not because of any changes in the criteria. So we now have around 17.6% of the total credit portfolio as stage 2, 6.2% of the credit portfolio as stage 3, and the rest is stage 1. The most important thing is that we have very strict criteria with regards to staging. Although we do have individual assessment for some credits, which could be subject to obviously criticism from different parties, but based on the performance of the cash flows and payment of the installments, or based on actions that we are taking with those customers, those have been individually assessed. But in any case, we will, like I said, see an increase in both stage 2 and stage 3 in third quarter, and the in the fourth quarter and the first quarter of 2018. NPL ratios, as you can see, has a trend of going up. We didn't have any write-offs or sales of NPLs up until now. We could have a small sale in the last quarter within this period, not an amount that will hugely impact the NPL ratio. The cost of risk is, as you can see, stabilized around 2.3%, and the provisioning has also increased during this period for stage 3, as the aging of the and the recalculation of the loss given default for stage 3 comes in. On page 13, we try to show the dynamics of the NPLs, the new NPL formation, as you can see, given the additions, recoveries. So you can see the new NPL formation as around 454 million Turkish lira. We were able to do recoveries of 117 million, which is higher than all the other quarters, especially when you add them, even the last 3 quarters, even when you add them, it doesn't come to this level. Sorry, the last 2 quarters. We expect recoveries to continue because of the good collateral coverage, but it is taking more time due to the concordatas that have been that the Turkish companies have been adopting, which is slowing down the taking over of the collaterals over this period. The government has seen a lot of criticism coming in from the financial sector because of that. there could be a change in the laws and regulations concerning how companies can delay bankruptcy and taking over of collaterals by the banks. If that happens, the recovery performance will be faster, but we will probably reflect that to our loss given default calculations going forwards. That slowdown in collateral takeover, which would reflect as a higher provisioning for stage 2 companies. NPL inflow, when you look at it from a sectoral perspective, as you can see, it's a relatively mixed range. The top 5 sectors constitute essentially manufacturing and trading. Then comes construction and energy, and the rest constitute around 13.5%. When you look at the stage 2 credits sector distribution, again, we do have manufacturing and trading constituting a large portion of the stage 2 companies also. Here we have a larger construction sector of around 21%. But unlike our normal credit portfolio, we didn't have significant new formation construction companies, because most of the troubled construction companies, we had already taken them into NPLs or restructured them or taken better collateralization, so that we don't have many more troubled construction companies coming in the next quarters. This will probably be the opposite of what you will see in the rest of the banking sector. They were able to float their construction company customers, but most likely they will now be seeing them staging as 2 or 3 in the rest of the banking sector. Coverage ratios in stage 2, as you can see, are also high, especially in the stage 3 customers. In stage 2, it is low because of the high collateral base that we have. Based on past experience, our loss given default calculations give us around 240 million lira of provisioning in stage 2, which might be lower than the rest of the market, but it's essentially due to the high collateral coverage that we have. But like I said, due to the later acquisition of these collaterals because of the delaying of the bankruptcies procedures in the Turkish market that we are now seeing, we are likely to revise our loss given the default calculations, so that the provisions in especially stage 2 is going to increase going forwards. On page 14, when we have the funding profile, as you can see, the deposit base, the funds collected still constitute the largest portion of our portfolio. This is important, especially due to even at a time when we had low returns to these deposit bases compared to the conventional banking sector. We were able to keep a major portion. And like I said, we have also introduced new products that give high yields right away for especially customers more sensitive to these returns, especially the larger tickets. So we expect the funding base to be stable going forward. Wholesale funding side has been decreasing somewhat due to our lower appetite in that area. We had already announced in the beginning of the year that we would be repaying our November syndication fully. We also redeemed our tier 2 sukuk in April. We had already rolled over our November syndication in 2017 by 50%. So we had shown that intention to the market much before these developments took place. So we were actually in a very comfortable position over the last couple of months with quite enough liquidity to cover our short-term liabilities. We also took a very conservative stance with regards to our coming liabilities in 2019. We have, as you can see in the graph on the lower right portion, we have around 315 million syndication in April and 350 million senior sukuk in June. We are shoring up liquidity for these also. Depending on, we haven't taken a decision on what we are going to do, but towards the end of the year we'll be sharing that with the market based on how we see and our communication and talks with our investors also to see how much of that we are willing to roll over going forward. But we have currently enough liquidity generation in the bank that will allow us to fully repay all of this in the worst scenario going forward. Or further than that, liabilities essentially constitute of sukuks. One as a tier 1 sukuk of $205 million, which is a perpetuity, as you know. 5 plus, it's a 5-year sukuk, which can be, which is rolled over based on BRSA and our conditions on a perpetuity basis. And the tier 2 sukuk, again, we have one that is maturing in 2025. So that is still a way to go for us. So in the short time, term and medium term, actually, we are very comfortable with regards to meeting our obligations on the FX side. On page 15, we show you the funding profile on the wholesale fund. As you can see, we have 3 wakalas, sukuks, on the international issuances, amounting to 350, 250, and 205. These I've already talked about. And we also started this year doing domestic issuances in Turkish lira. Shorter term, usually around 90 to 180 days, but we also have 1 year CPI index. And yesterday we also finalized our first IPO, public offering for a Turkish lira sukuk of 350 million, so that not just qualified investors can buy, but also public can buy. It was a quite successful one for a first-time issuance for us. We also established custodian services within the bank. So essentially, all of the operation has been done. Most of the operation has been done by our bank for this new sukuk issuance, public offering sukuk issuance. We are seeing this as a good and successful method, and we will continue doing these Turkish lira domestic sukuks. It is part of our intention and strategy to increase our Turkish lira funding base, not just based on deposits, but also based on capital market products also. And the last table on that page shows the syndicated Murabaha credits that we have. The November issuance we're fully repaying, and the April syndication constituting of 2 tranches, one in $200, $45 million, and the rest in euros, 60 million euros. Again, based on the market conditions and our conversation with our investors, we are going to decide on how we are going to go forward with regards to this syndication towards the end of the year. The next page, on page 16, we have the funding profile of the collected funds, the deposit base. As you can see, the current account portion of our funding base has been increasing compared to last year. We now have close to 30% of our deposit base in current accounts, which I think is an important achievement that we had within this year. I think it's also a muscle that we are strengthening because of cross-sale products that we have been introducing as credit portfolio growth was subdued during the year. As you can also see, within that current account portion, the larger increase has been due to Turkish lira current accounts. And although we do have somewhat, in real terms, a decline in participation accounts, like I said, this is due to the low returns of these participation accounts, and we are compensating this by introducing new products, and we will see a rise in the general deposit base that have returns going forwards. Especially now that the deposit rates in the market is starting to stabilize. The cost of funding is increasing and will probably be increasing a little bit in the fourth quarter also, as the older deposits mature and become rolled over at higher costs. So the average will probably increase, but the marginal cost of deposits, like I said, is stabilizing going forwards. We have around 42% of our deposit base in Turkish lira terms. We are, inshallah, going forwards, going to see this rise in the future. And the maturity composition is essentially short term, as you can see, 30% being current accounts, around 20% 1 month accounts, and around 40% up to 3 months accounts, which reflects the conditions in the Turkish banking sector and behavior, actually. I mean, this is not something new, but as you all know, it has been going on since more than 20 years now. We have a short-term maturity and a maturity mismatch because of that in the banking sector in general. On page 17, we have the off-balance sheet items. Essentially, as you can see, in the past years, we had grown a lot in the letter of guarantee business to more than 40% compared to total assets. Our target was to grow that to lower than 20%. As you can see, we had achieved that in 2017. We are now continuing with that trend in general. That is our risk appetite in that area. So we are seeing reasonable growth in letter of guarantee business on a quarter-to-quarter basis and a year-on-year basis. This is also helping us generate commission income going forwards. This year we have also seen our foreign trade business boost, both because of the Turkish exports, but also because of our enhanced focus in foreign trade, especially to the Middle East and North Africa, where we have an advantage because of our sister banks in the region. We do have a representative in Algeria that is also looking at sub-Saharan countries. He's helping our customers in the region, which is a service no other bank offers. and because of that we get a huge portion of the business, Turkish foreign trade, to the region, and we will going forwards replicate that model in other regions to get a larger portion of the business, foreign trade business, in those regions also. On page 18, we have the income cost dynamics. Net profit share income has risen by 46% on a quarter-to-quarter basis, and on a year-to-year basis, it is a bit low. Essentially, due to the year-on-year basis, due to no credit growth, but quarter-to-quarter basis due to the yield hikes that we saw in the last quarter. Net fee income on a year-to-year basis has gone up by 17.5%. It is somewhat lower compared to last quarter, but we are expecting this to pick up again in the fourth quarter going forward. Trading income, obviously, the largest portion of that is due to the dollar-denominated Tier 1 sukuk that we have. As exchange rates goes up, obviously we do gain from that because of the position that we have there. And in the last quarter, because the exchange rate went down from the level of 6.5 to currently 5.3. If we expect that to continue towards the end of the year, we will see some decline in that additional income we got from the net trading income in the last quarter. Other income is essentially due to the reversal of the IFRS 9 provisions that we saw in the first quarter, which is a one-time thing only. And as you can see, in the last quarter, the other income is significantly lower compared to the previous quarters. Provisioning is obviously up and will continue, as I said, because of new NPL formation, plus a higher or a more conservative loss to given default calculation for stage 2. We can expect that to go up in the fourth quarter, and I will be sharing our budget and expectations for the full year 2019, especially concerning the asset quality and provisioning for 2019. Staff costs has increased by 20%, lower than the inflation rate. Obviously, going forwards, we are, like I said, working on the budget, but we do expect a reasonable rise in the wages, salaries of our staff to compensate for the inflation rise. But we're not growing on the staff size that much, so it will be compensated by that. Other costs, again, we were able to do some cost management there. So the growth essentially on the other costs have are lower than the inflation compared to last year, and even on a quarterly basis, there is lower costs, operating costs on a quarterly basis. We did open some branches in 2018. It is highly unlikely that we will have new branches opening in 2019. Maybe a few very small retail branches in places that we believe are going to be profitable in a short time. But other than that, we're not thinking about opening new branches. Rather, we're giving more focus on digitalization and channel migration in 2019. The page 19, the next page, gives you our year-end guidance. As you can see, We do expect the year from now on the last quarter, the decreases on balance sheet items, the total assets, credits, and fund collected on Turkish lira terms because of the decline in the exchange rate, essentially. We could see around 16% growth on total assets on a yearly basis compared to the end of the year 2017, around 14.5 to probably it could be a little bit lower than this given the current conditions that we expect with regards to credit growth. And funding side, around 12.5% yearly annual growth compared to end of the year in 2017 on the funding base. But again, this could go for the positive. We could have a bias on the here. It could go even better than this, close to 15% due to the new products that we are now introducing. But these are reasonable assumptions that I think conservative assumptions that we believe we need to share with our investors. On the net profit side, again, currently we have around 372 million. We could expect that to go to 425 to 450 million, based again on the provisioning policy, whether the new NPL formation and whether we will adopt the loss given default recalculation as of end of last quarter or the first quarter of 2019. Branches, 230 branches. It looks like 3 more branches are going to be open, but these are already rented places and the construction is almost finalized. So there won't be additional capex because of these. Staff, we might have some staff hiring on the IT side going forwards and on the analytical side. But again, this is a conservative approach number. We could have something below this by the end of the year. Return on average equity and on average assets will probably be around these levels that we currently have now. We could expect around 15% by the end of the year for return on equity and 1.15% for average assets. Our expectation for the year-end inflation is around 23%. It could be a little bit higher than this based on December inflation. We are yet to see the impact of the FX and the policy actions that the government took in fighting inflation. So December figure is going to be very important. This is a tentative figure that the real inflation rate will probably be reflected on the salary rises. And for the whole year, GDP growth will be around 2%, as our chief economist chief economist's model is giving us. We are seeing essentially a major contraction in the manufacturing and production index and confidence levels in especially the last quarter. On page 21, we have a market share, the graphics. Here, from a sector perspective, we haven't changed much position, obviously, but within the participation banks, we haven't been very aggressive. We have concentrated more on liquidity position rather than growth, and that has reflected as a smaller market share on the credits, assets, and funding side. On page 22, you can see comparison of our financial ratios with the banking sector in general and participation banks in specific. We have comfortable levels of capital adequacy ratio. Our NPLs seem higher than the market, but like I said, like we have always said, we are essentially very transparent with regards to reflecting the asset quality on our financials. We believe it is important for a sustainable and long-term both communication side and also from trying to face the problems upfront. I think is a major policy that separates us from the rest of the market. We believe the market is going to come close to our levels. As you can see, even compared to last year, it is increasing in the banking sector. It is likely to increase even further going forwards in larger increases than we will be seeing in our portfolio. Coverage ratios are lower than the market, but it is increasing. And like I said, with the loss given default recalculation, it is likely to catch up with the rest of the market. Because of our liquidity priorities, our loan-to-deposit ratio is lower than the market, and as should be, I think, in the given conditions. Our return on assets are lower than the rest of the market, but our return on equity is reasonably in line with the rest of the sector. Asset yield is lower because of our higher liquidity position, and spread, as you can see, is in line with the rest of the market, as is the but the net profit share margin has come down because of the faster growth on the total funding costs. We have, going forwards, we will be concentrating more on operational cost management. It hasn't fully reflected to the operation cost to average assets ratio, but as you can see, it has reflected directly to cost to income ratio. Some of that is due to the tier 1 income, higher revenues because of that, but it's also because expenses did not rise as fast as inflation because of cost management in the bank. We are giving more attention to efficiency, as can be seen in the number of the credits per branch. It has increased compared to our previous years. It has increased significantly in the banking sector because they are closing shop. The branches closed in the banking sector is increasing, which reflects as a direct increase in credits to branch ratio initially. Whether it will impede their growth levels in the future, we're yet to see. Staff to branches is coming down in our case also. Again, we're opening, if we're opening branches with smaller number of staff, and also we are slowly reducing the number of staff in our branches in the general management also. And current account to deposit ratio is, like I said, above 29%, significantly higher than the banking sector, but lower than the other participation banks in general. The rest of the presentation has the appendices, a summary of the balance sheet, the income statement. So this brings us to the end of our financial results presentation. Thank you for taking the time to join us on this call. I think we now have